Assalamualaikum warahmatullahi wabarakatuh. I'm Renita Femadevi, an accounting student in class F. In this opportunity, I'd like to explain you about introduction to accounting, Chapter 1. This chapter introduces accounting and provides a short history of management accounting. It describes the early role of the management accountants and recent developments that have influenced the role of non-financial managers in relation to the use of financial information. The chapter includes with a critical perspective on accounting history. It's not easy to provide a concise definition of accounting since the word has a broad application within businesses and applications. The American Accounting Association defines accounting as follows: the process of identifying, measuring, and communicating economic information to form informed judgments and decisions by users of the information. The definition is a good place to start. Let's look at the keywords in the above definition. It suggests that accounting is about providing information to others. Accounting information is economic information. It relates to the financial or economic activities of the business or organizations. Accounting information needs to be identified and measured. This is done by way of a set of accounts based on a system to accounting known as double entry bookkeeping. The account system identifies and records accounting transactions. The measurement of accounting information is not a straightforward process. It involves making judgments about the value of assets owed by a business or liability owed by a business. It's also about accurately measuring how much profit or loss has been made by a business in a particular period. As we will see, the measurement of accounting information often requires subjective judgment to come to a conclusion. The definition identifies the need to accounting information to be communicated. The way in which this communication is achieved may vary. There are several forms of accounting communicating, each of which serve a slightly different purpose. The communication need is about understanding who needs the accounting information and what they need to know. Accounting information is communicated using financial statement. What is the purpose of financial statement? There are two main purposes of financial statement. One, to report on the financial position of an entity. Second, to show how the entity has performed over a particular period of time. Accountability. Accounting is about accountability. Most organizations are externally accountable in some way of their actions and activity. They will produce reports on the activities that will reflect their objective and the people to whom they are accountable. How accounting information helps businesses to be accountable. As we have said in our introductory definition, accounting is essentially an information process that serves several purposes that are providing a record of assets owned, amount owed to others, and monies invested, and then providing reports showing the financial position of an organization and the profitability of its operations, helps management actually manage the organization, and then proves a way of measuring of organization's effectiveness, and then helps stakeholders monitor an organization's activities and performance, and enable potential investors or funders to evaluate our organizations and make decisions. There are many potential users of accounting information, including shareholders, lenders, customers, suppliers, government departments, employees and their organization, and society at large. Anyone with an interest in the performance and activities of an organization is traditionally called a stakeholder. The main financial accounting statement. The purpose of financial accounting statement is mainly to show the financial position of a business at a particular point in time and to show how the business has performed over a specific period. The three main financial accounting statements that help achieve this aim are: 1. The profit and loss account or income statement for the reporting period. 2. A balance sheet for the business at the end of the reporting period. And the 3rd, a cash flow statement for the reporting period. A balance sheet shows at a particular point in time that resources are owned by a business and what is owed to other parties. It also shows how much has been invested in a business and what the sources of the investment finance were. It's often helpful to think of a balance sheet as a snapshot of a business, a picture that the financial position of the business at a specific point. Which this is a useful picture to have every time an accounting transaction takes place. The snapshot picture will have changed. By contrast, the profit and loss account provides a perspective on a longer time period. If the balance sheet is a digital snapshot of the business, then think of the profit and loss account as the DVD of the business activities. The story of what financial transaction took place in a particular period, and most importantly, what the overall result of those transactions was. Okay, that's all about the explanation. For lesson more, I do apologize. I hope this reading passage can be useful for you and can enlarge your knowledge. And so, thank you for watching. Wassalamualaikum warahmatullahi wabarakatuh.